Hello, everyone, and welcome to the Your Mark on the World show. I'm your host, Devin Thorpe, and I'm a contributor at Forbes covering social entrepreneurship and impact investing. And our guest today is David Weild, Chairman and CEO of Weild Co. Company. Thank you very much, David, for joining us. We're just thrilled to have you.
Thanks, Devin. Good to see you again.
We started a minute or two late because you and I had a minute or two to talk before the show started, and we got talking about what we're talking about today, and it really is just a fascinating topic for me. You really played an instrumental role in the development of the Jobs Act and have a real passion for growing the economy. Give us a sense of the problem you see in terms of the markets and the reason we're seeing so few IPOs.
Well, first of all, there's a lot of pop wisdom out there. People believe that venture capital has stepped in to fill the capital void in U.S. markets and private equity. And actually, there's an economist, Robert Lighton, who's done some work that shows that the number of startups, or the percentage of startups in the U.S. economy, went from about 15% of all companies back in the late 70s all the way down to 8% today. So we have a crisis on our hands. And one of the things that you report on, Devin, is social impact. I like to say that we're the greatest social impact story ever told, because what we're passionate about is getting more capital into the hands of scientists, engineers, and entrepreneurs, because we see them as the folks that are going to find solutions to the key problems of our time. I have very little faith in the ability of human beings to restrain themselves, like when we talk about global warming, but I have immense faith and confidence in the capital markets' ability to finance scientists and engineers will find solutions to global warming or cures to cancer. And so I think that actually getting the level of activity up in those parts of the economy, because small business creates all the jobs. And as you know, we are having a real jobs crisis on our hands globally. And part of it is because we created these market structures that were hyper efficient, that didn't support capital access for small companies and aftermarket support. They're all related.
Let's talk about the problems a little bit deeper. What are the regulatory issues that you see that have created this? Is it just the hyper efficient markets, the program trading and the flash trading? What's going on that creates the lack of IPOs in our markets?
Well, when you see things like high frequency trading and flash crashes, a lot of that is symptomatic. The real problem is that we created a one size fits all market structure that was optimized to trade in innately liquid stocks, right? Where there are thousands of buyers and sellers looking at Intel or Exxon at any particular point in time. And in some respects, the best thing to do is to get out of the way and let those order books interact. They're going to trade just fine. I think you still have to worry about some of the gaps, the flash crashes, the mini flash crashes that are caused. I'm not sure that's been totally thought through by the regulators. But the key thing that they did was they took this hyper efficient, low cost market structure, one size fits all, and they applied it to every stock in the market. And that includes the small cap stocks on Nasdaq and the New York Stock Exchange and the over the counter stock market. And so what happened was these stocks trade asymmetrically. Big buyer, no seller, big seller, no buyer. And you need human beings to get in there, commit capital to create liquidity, and to get on the phone and market what we used to call the old competition of ideas. And by taking all of the stock salesmen and brokers out of the middle, and taking all of the market makers out of the middle in terms of committing capital, I think predictably collapsed liquidity. Institutions, abandoned many of these smaller capitalization stocks. And so now the cost of capital and the access to capital, the whole ecosystem is deteriorated. We had 160 plus investment banks back in 1994 that took at least one small IPO public. And today that number is down to just a little bit above 30. Okay, so that whole ecosystem that supported entrepreneurial access to capital has largely collapsed, and we have to build that back. And the way that we're going to do it is we're going to create economic incentives in markets, or we'll also, one of the things that my company is working on is the technology to kind of crash the cost of finding smaller, more appropriate investors, just better, faster, and less expensively.
Now, David, some interesting things happened in the Jobs Act, and you worked closely on that to bring that about. And a lot of it was intended to increase access to capital for small enterprises. What's working? What's not working? What more do we need?
Well, let's start with title. The four major titles, titles 1 through 4, that were just really square focused on capital formation. Title 1 went into effect immediately. That was the so-called new category of emerging growth company. And the two major things or three things that does, which are important. One is it created a testing the waters provision. So for heavy IP companies like biotechnology companies, the old way of doing it was you get on the road on the IPO and you spend one 45-minute meeting with an investor in a very complicated company with an institutional investor, and they have to make a decision. And nobody's going to invest $5 million for 5 years on the basis of one 45-minute meeting on an IPO roadshow. So you can actually get out now and pre-market. There's a bright line safe harbor meeting with institutional investors. And so you can develop that kind of following by doing some upfront work. And as a consequence, we've seen partly as a consequence of this, we've seen a much better small IPO market over the last few years, which I think has got terrifically positive impact for healthcare over the long run. Obviously, these are the guys that are going to help cure cancer. The second thing is confidential filings, right? So this is a risk mitigation piece for companies. You can file now, and if you can't get through the SEC or there's some disclosure issues or accounting issues, and you decide to pull the transaction, you can do that without basically airing all of your secrets in public. So that's a great risk mitigation tool, and I think that's been incredibly well received by the market. And then there's something which was a provision that at the 11th hour, we actually worked with the House and the New York Stock Exchange to have put into the act, which was to get the SEC to investigate the impact of tick sizes or decimalization on, which is the aftermarket economic incentives on capital formation. And the tick size, for those that are watching, is a little inside Wall Street, but it's the minimum price increment that you can trade a stock in. And all stocks in this country are essentially traded at 1 penny tick sizes. And so what the SEC is going to test in a pilot coming up later in 2016 is to try and see how nickel tick sizes in smaller capitalization stocks will impact trading and liquidity.
So with that test, will they just choose a cohort of stocks, small cap stocks, to trade in a nickel increment, and then we can compare that to the rest of the market, including perhaps an identified cohort of similar stocks that aren't trading that way?
Actually, that's exactly what they're doing. There are 4 buckets. There'll be a control group, and then there are 3 different test buckets, including testing some controversial things like the trade at rule. There are some people that have said, because the tick size pilot itself was designed by the stock exchanges, that sort of you end up with a little bit of misbehavior in the design of some of this stuff. Some of it's overly complicated, and so we have real questions about whether or not the control group is actually going to be a real adequate control, because if you don't have real representation of the different types of market makers in each of the 4 buckets, if some people pull out of one bucket, but you can't, and that's not controlled for, then it's not a real test. So we'll see. I mean, it's you don't want to run into a situation where it's garbage in and garbage out. And one of the problems with a short-term tick size pilot is that it's really not going to tell you whether or not people would invest in bringing back the ecosystem and more equity research to support these companies and more people to make markets, commit capital. There's always a chance that this won't become the new way of doing things. So you're not going to make major investments in human capital, which I think is really important to the quality of small cap markets.
Yeah, we could just drill down on this forever, but we ought to jump to Title II, because I know there are a lot of people that are interested in Title II and Title III and Title IV. I want to get to Title IV for sure, because I think that's kind of the hottest area. But let's cover what you think the impact of Title II and the general solicitation provisions have been so far in capital formation?
Well, there are quite a number of what general solicitation does, and that actually came right out of a paper. It was a recommendation, I think, on page 30 of a wake-up call for America. What we had hypothesized or theorized was, look, it doesn't matter who you market to. When Mark Zuckerberg was before he was taking Facebook public, I mean, he was going to be awfully concerned about getting on TV and so-called conditioning the market. And what we're saying with private placements, it shouldn't matter who you talk to. It matters who you actually take money from, right? So why should non-accredited investors not hear the story? I think it frankly would be better culturally for us to allow everybody to hear the story. And so we now have a general solicitation rule. I think that one of the problems with the rule is that it's a little onerous from the standpoint of if you go through regular Reg D private placement, individual investors can check a box and declare that they are accredited, and that's all that needs to happen. So it's a self-selection process. Here you have to have a third party effectively identify and verify on some level that that individual that invests is accredited. And so that adds another layer, and that's been a little bit of friction that I think has made it maybe less widespread, less easy to adopt on a widespread basis than otherwise might be the case. I mean, my guess is that they may modify those rules over time, because I'm not sure that level of control is frankly necessary. At the end of the day, people should be subject to a fraud statute, and if they lie about their accredited investor status, that shouldn't be the companies that's raising capital. Their problem, in my opinion.
Yeah, that makes sense. Now, Title III, we can almost skip over that. Title III, the true crowdfunding for non-accredited investors, very exciting. All kinds of discussion about that for the last 3.5 years. The rules are pending, but we still haven't been issued. So as yet, no impact, right?
Well, that's right, except that that what I would say is that the word in the circles that I travel in is that that the commission is poised to release the rules in the next 60 days or so.
Yeah, that's what I'm hearing too. Let's keep fingers crossed, at least those of us who are excited about that. So let's jump to Title IV. Reg A Plus changes implemented in June of this year really has created quite a stir, a lot of enthusiasm. I've done a couple of episodes on that. What's your take on the impact that's having in capital formation?
Well, in general, when rules are changed at the SEC, and I've heard this from Marty Dunn, who was a former head of the Division of Corporation Finance, is an attorney at Morrison and Foster now. And this has been the tradition. Linda Quinn, who I had done some innovation, was another head of the Division of Corporation Finance many years ago, tragically passed away. But the SEC, or many of the insiders, are always surprised at how long it takes the market to adopt and take advantage of new rule changes. Very often it takes a year, and the reason is that your securities counsel is concerned that their clients not be the first one, because they might miss something from a liability standpoint. So it's a little bit, the metaphor that I use is it's like penguins at the edge of an ice floe, and everybody's waiting for the first ones to jump in to make sure that they don't get eaten by sharks. And once you get a few proof points out there, then steadily people have more courage of their convictions to kind of get involved. My understanding on Reg A right now is that there were about 30 transactions that were filed with the SEC. There's about 24 that are still in place. I guess 6 were withdrawn for some reason. About half of them are Tier 1, half of them are Tier 2, which is a surprise to people. I think most people thought that because you'd file under Tier 2, because that gives you an exemption from state blue sky regulation.
Right.
And so even smaller offerings would elect to do Tier 2, but that's so far I'm hearing hasn't been the case.
There must be a lot of New York offerings as a result. I mean, because doesn't New York have a friendly state regulator, and you could raise all your money in New York?
Yeah, that's
more easily
true.
than in Utah or Idaho.
Right. I mean, if you go to a big state and you're raising a small amount of money, and most of your capital raising is going to be local, and you know that you can get it passed, then why not file under Tier 1, because it's got an even it has a very, 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 very slimmed down, next to no requirements. So yeah, I think on some level it is, fairly logical. I think what's really fascinated most of us is that none of us expected to see Reg A plus. And by the way, I testified in Congress in support of this bill, and some of the provisions actually came directly from me, like the bad actor provision was a suggestion we made. What became the tier 2 disclosure requirements was a suggestion that we made. We feel that information standards ultimately are absolutely critical to the aftermarket. People need an audited financial statement. And so these things were widely adopted. But what's been fascinating to me is I don't think that I anticipated that Regulation A plus would be co-opted for crowdfunding. And it appears right now that Regulation A plus, maybe because of the lack of Title III rules, but also because you can raise up to $50 million in Regulation A plus, and there's a cap on Title III of only $1 million, that it may be that Regulation A plus becomes the crowdfunding construct of choice.
Yeah, it is an interesting development. I've seen that with the Elio Motors effort. I don't know if you follow that one, but they have been testing the waters, and I think they have $35 million of interest expressed last I heard. And so it seems to be working really well, but very much a crowdfunding style offering in that case. So it will be interesting to see how all of these things that some have called crowdfunding across the board, from Reg A to Title II, Title III, all of that kind of mushed together, but it will be exciting. What do you see as being, what are the additional changes you think we need to fire up that IPO market to the level where you think it should be? And where do you think it should be relative to where it is?
Well, we have, legislation has been a bit patchwork in general. And I'd love to be able to sit down holistically and look at we need scale disclosure, right? Small companies, the smallest companies can't really absorb any kind of a regulatory burden. I mean, I am a big believer that we've overthought and way overregulated crowdfunding. There's a way, for instance, if the interesting limitation to me was, that a public investor or a non-accredited investor could only invest $5,000. That's a great way to limit risk, right? And with blockchain technology, for example, and other approaches, you should be able to figure out that indeed only one individual, if they put their social security number, is that they can't take multiple shots and subvert that restriction. So that's a great risk mitigation tool. I think when you do that, why do we care how much money? Why should there be $1 million cap? There was a lot of concern years ago. I had this conversation with Jack Coffey, who was the professor of law at Columbia, and he testified in the Senate. And Jack, had called the Title III something to the effect of the Boiler Room Act of 2011, 2012. And I made a distinction. I had a discussion with him where I said, look, Jack, I think portals are incredibly different than broker intermediated trades, where a broker has an incentive to sell a product. Here, if a portal does a bad job for the market, they're going to go out of business, right? The crowd is a paradigm shift. The crowd is going to do a terrific job at isolating fraudsters and controlling for that. And so, we have, ironically, we have things like Kickstarter and Indiegogo that are totally not regulated, and the sky hasn't fallen. And guess what? They're selling people things, okay? But those people don't get to participate in the upside of the company at all. So, which is worse? And I would argue that, we need to get out of the way of crowdfunding portals, not broker intermediated trades. It'll be very Darwinian. We had this same discussion years ago about peer-to-peer auction markets. And guess what? eBay emerged. Everybody's incredibly happy with the performance of eBay. It's done a wonderful job of creating approaches and technologies to get the bad actors sort of to limit the exposure in that marketplace. Otherwise, it wouldn't have thrived and survived, and yet it has. And so I think that there's a lot of old school thinking. Most of the securities regulators, are of a certain age, and they haven't grown up with the crowd. And so I think that getting people to think a little bit differently and to be a little bit more worried about what could be in terms of the potential of these markets, as opposed to everything that could go wrong. Particularly in a marketplace where, look, I mean, labor participation rates in this country are back to where they were. We've done full circle all the way down to where they were in 1978, okay? The jobs market fell apart in this country when we started to make these aftermarkets really hyper efficient, okay? It's just, you can totally overlay it on that. And when you look at 16 to 19-year-olds, labor participation rates are way down. So young kids that just have high school educations are not getting, into the economy. That's really, really bad. It's particularly bad for young African American males in particular. You need full employment to get kids that are on the bench into the economy and to teach them a skill. And if you look at the only age demographic that's really increased has been the over 65 group, and it's skyrocketed, and that's because people can't afford to retire.
Yeah.
So I think that if you look at where jobs come from, they come from small companies. You look at way back at the beginning of the interview, you look at the startup rates going from 15% of all companies down to 8%. We got to get out of the way and get this economy moving. We got to create jobs. We got to get money into the hands of entrepreneurs. That's what Weild Co is all about, and that's our partners. That's what our lobbying efforts are about, because we think that this is essential to creating ultimately a secure, vibrant America where the American dream still has promise. And I think increasingly we're getting people to understand that. But boy, I'll tell you, it is a struggle because it's not intuitive. The popular wisdom is that if you have low cost trading, it's good for everybody. And in point of fact, the average African American in this country has a net worth, according to the Pew Institute, of $11,000. They derive no benefit from low cost trading because they don't, on average, have money in the markets. Okay, so we got 20% of American kids are living below the poverty line, right? So there's a paradox in stock markets where actually investors, if you charge more and you support these markets more robustly, investors will do better because it will drive economic growth, and economic growth rates ultimately drive investor returns. And consumers will benefit because there'll be greater innovation in products that benefit consumers' quality of life. And so taken together, we need to get the politicians, the regulators, to really think with a bit more vision about how these markets are structured and what they need to do to drive economic growth and opportunity again. Because as sure as I'm sitting here, Devin, this has been the Achilles heel of the U.S. economy.
Yeah. There seems to be great evidence of that. Well, David, our time is up. Before we go, please tell people how they can follow up with you or learn more about your thinking, learn more about Weild & Company, engage you for something. How do people get you?
Well, it's easy. My email is david.weild, Weild, @weildco.com. And, I respond to all my email. And probably the easiest thing to do, of course, their website's just weildco.com. And you can track me down through the website as well.
Fantastic. Well, David, we really appreciate you taking the time to be here with us today, and we wish you every success in making these market changes that we need to restart our economy. So thank you very much, David.
Thank you, Devin. It's good to see you again.
All right. Thank you. Let's do some good.
Thanks.